everybody. Welcome to Monday Morning Must Knows. My name is Merlin Rothfeld, and here are a bunch of things to pay attention to for the upcoming trading week. Now, earnings season, the big guys are out of the way, but we do have a ton of them reporting and a couple actually big names. So let's start there, and then we'll talk about last week's Monday Morning Must Knows and interest rates. Here is our earnings calendar for the upcoming trading week. Now, we've gone from 700 plus down to 542. Oh, just a small 542. That's still a lot of companies reporting. You have Arista Networks as well as Advanced Auto Parts on Monday. Tuesday brings you Alibaba, and of course that's in red because, again, they've been trying to report for the past few weeks, and they're supposed to report again on Tuesday. We also have Wynn and Welltower. Wednesday brings you Nvidia, Cisco, Applied Materials, Baidu, Kraft Heinz, The Trade Desk, and Shopify. This is the monster day of the trading week, especially given how much some of these have moved. Some are down over 50%, and some are absolute bellwethers in their industry like Nvidia. Thursday brings you Roku, who's also been just decimated over the past few months. You have Walmart and Dropbox. And Friday, we've got John Deere and Allianz, a big insurance company globally. All right, so that's your earnings calendar. What I want to do is look at some things that might impact our markets much more aggressively. Now, certainly earnings can impact your markets, but big picture, again, it's about interest, it's about inflation, and it's about spending. So let's take a look at retail sales numbers. Now, retail sales numbers have been very volatile ever since the pandemic. Now, on Wednesday at 8:30 a.m. Eastern Standard Time, this announcement comes out. And as you can tell, there's been a tremendous amount of volatility here compared to the historical norm, which is everything on the left-hand side of that chart. You can see where the pandemic hit and these wild swings up and down. What's noteworthy is what's happening on the right-hand edge of this chart right now. The most recent reading, which came out in January, was negative 1.9%, which means we're seeing a contraction in spending. Remember, spending makes the U.S. economy go round. If we don't spend, economy comes grinding to a halt. Now, 1.9% decline is pretty significant, but it's only 1 point data. Now, the trend has been going down over the past few months, but what's concerning is that January report was for December's numbers. They should have been good, right? December, Christmas shopping, holiday shopping, it should have been pretty good numbers. Negative 1.9 is what we actually got. That's not good. Now, the expectations are we're going to come out at a positive 1.8% for January spending, which would be pretty good. Keep your eye on this announcement because any wild fluctuations here could certainly have an impact on the overall financial markets and, of course, the equity markets. Now, last week we talked about bond futures, we talked about bond yield and why that was so important. Let's revisit this chart just so we can draw a picture of what happened last week and what might happen in the weeks going forward. So last week we showed you the 10-year Treasury. Remember this chart? We showed you this nice arch here. This is the 10-year futures product, which is the inverse of yields. Now, it came down towards that little area of demand, that little red line you see, and really I mentioned if it gets below that, there's not a lot of demand zones that are close by, so it could really start to seek out much lower levels on this Treasury futures product. Well, lo and behold, focus on the right-hand side. We'll show you what happened last week. Boom! Big breakdown there. That is a pretty significant move to the south side. Now, that's on the Treasury futures. And I thought this week maybe we would flip that picture and show you what it looks like on the bond yields. Now, of course, it's an inverse picture, right? When the futures are selling off for bonds, yields are spiking. And we've seen tremendous moves in yields over the past few weeks. So let's take a peek at how it looks on our 10-year yield. There's that red line we had before. You can see that same breakout. Now, what I want you to do is take a step back, because a lot of traders around the world, they like to look at patterns and different chart formations. Check this one out and see what you guys think. Here we have an uptrend on the bottom. Those lows are starting to get higher and higher. Now, the high just broke out, which is good news. This is what's called an ascending triangle. Now, one measurement way that people like to look at a ascending triangle is to measure from the bottom of the triangle to what they call the baseline. That's that green dashed line you see that just showed up on your screen. And what they'll do is they'll take that distance and they'll measure it from the breakout point to give an anticipation of where price may go. Now, in order to see that, I've got to go back and look at a much longer term chart. So let's go back to a monthly chart of this all the way back in the 1980s. Now it distorts our picture tremendously. Look at the little ascending triangle on the right-hand side of your screen. There's the little green measuring object. If we take that and move it up and show where it might go to, at least as a forecast, that's showing right around 3.25%. Now, granted, we just breached 2%, and the trading world's going, oh my goodness, this is horrific for the markets. It's really not that bad. I mean, look at the chart. Long term, it's been trending down since the 80s. And the important part here is saying if we get to 3.25%, and who knows when that can happen, right now the trend is up for interest rates. It's pretty clear the Fed is going to stop their tapering. They're going to cut the tapering back, and they're also going to be raising rates. So that would support the argument for higher interest rates. But we're still not back to this red box here, which is going back into the 1980s. Now, in the 1980s, we had interest rates much, much higher. You're looking at 12, 13, 14, 15%. And that's when we had inflation that was slightly higher than where we are now. So at some point, we're going to see one of two things happen. Inflation will fall tremendously and everything will go back to normal, or we're going to see these rates rise much more significantly. And could we get to 3, 4, 5, 6, 7%? I have no idea. Bottom line is, as traders, as investors, we have to look at our positions, look at our portfolio, and plan accordingly. And when the signals are there, we need to react to those signals and make sure that we're in the right financial spot, because you certainly don't want to be going against a market that has incredibly increasing inflation. We will see you guys next time on the Monday Morning Must Know.